Over the past year, Cisco is down by 11%, which means that currently they are trading very near their 52-week low. Now, jumping straight to my stock valuation spreadsheets, as always, I will plug in Cisco's ticker and all the metrics will show up automatically. And if you want to download these spreadsheets, you can do so at the link in the description. Now, right away, we can see that the company has a starting dividend yield of 2.86%, which is quite nice. It is above average, but something I don't like too much is their trailing free cash flow payout ratio sitting at 56.57%. Now, what you have to understand is that Cisco isn't in a sector that is too innovative. So actually, I'm quite fine with their free cash flow payout ratio sitting at 56%. Now, jumping straight to the 9-pillar analysis, the company gets a rating of 5 out of 9, with 4 pillars currently sitting in the red. Now, as I always say, the most important thing for long-term value investors is the company's financial growth. And as you can see, their 5-year revenue CAGR is actually sitting at 10.10%, free cash flow at 12%, and net income at 40%. Now, if I jump to pillar 3, that is the revenue, you can see that it grew from 51 billion in 2020 to 80 billion in 2024. The net income increased from about 524 million to 1.9 billion, and the free cash flow grew as well. So you can see that the company's financials are growing. But if we jump back to Seeking Alpha and have a look at the 5-year chart, over the past 5 years, the company is actually down by 6.51%. So to me, it seems like the market is being quite irrational. But let's jump back to the 9-pillar analysis and have a closer look at the company. The first thing that captures my eye is that their 5-year profit margin is sitting at only 2%, while we want it to be above 10%. Now, what you have to understand is that it is quite usual for companies like Cisco to have such low profit margins. But something I do want to point out is if we zoom into pillar 6, the profit margin of Cisco has increased from 1% in 2020 to 2.40% in 2024. That's a 100% increase. And not only has the profit margin been increasing, but the return on invested capital has been increasing as well, from 6.18% to 14.24%. And well, what this means is that the company has been gaining market share and that they have been spending less money to make more money. And obviously that is great. Now let's also have a look at their 5-year PE ratio and their 5-year price to free cash flow, which are both sitting in the red. The 5-year PE ratio is sitting at 42.65, which means that investors on average over the past 5 years were spending $42 for every single dollar of Cisco's net income. Now, if we move closer to pillar 1, you can see that currently the PE ratio is sitting at only 18.42. That is more than 50% lower than the 5-year PE ratio, and it is in the range we would like it to be in. And as you can see, it has decreased by a lot over the past 5 years. So Cisco is trading at a huge discount compared to their historical values. Now, moving to pillar 2, that is the price to free cash flow, that is currently sitting at 16.70, again lower than the 5-year average and in the range we would like it to be in. So based on everything we have seen so far, Cisco is looking quite undervalued. But let's have a look at the few final metrics. First, I want to point out the company's debt levels. Their long-term liabilities over the 5-year free cash flow negative dividends is sitting at 4.60, which means that with the free cash flow they are currently generating and the dividends they are currently paying out, it would take them more than 20 years to pay off all their long-term liabilities, which of course isn't ideal. But based on Cisco's historical financial growth, this doesn't really bother me all that much. Now, if you have made it so far into the video, I just want to let you know that I have started teaching investing in online one-on-one sessions. So if you have just started investing and have questions or simply want to learn all about stocks and the stock market, how to value them, when to invest, and which metrics mean what and why they are important, you can sign up by going to the link in the description. We are currently running a 20% discount. Now, before calculating Cisco's intrinsic value, let's have a look at their dividends. Their 5-year dividend CAGR is sitting quite low at only 2.22%. And if we zoom into pillar 8, you can see that that is indeed lower than the average stock year-over-year dividend growth. But that is made up for by their higher dividend yield of 2.86%. Now, something I do want to point out is that their 5-year free cash flow payout ratio, as we know, is sitting at 56%. But if I scroll down, you can see that over the past 5 years, it has actually decreased by quite a bit, and this tells me that Sysco does have the means to increase their dividends. So now that we have gone through the 9-pillar analysis, let's calculate the company's intrinsic value. And as always, first jumping to the Graham's formula revised, I will plug in the high earnings per share growth estimate at 10%, medium at 8, and low at 6. I will then average this out with the analyst predictions and get a 5-year earnings growth estimate of 8.21% into the next 5 years. I will then take all these 6 metrics and get an intrinsic value of $54.56, which is actually 24% lower than the current trading price. But we still have 3 more valuation models to go through. So moving to the discounting cash flow model, we will plug in the free cash flow of the company over the past 5 years and calculate the growth rate into the long term using the same method as before. We will then use this growth rate of 8.3% to predict the future free cash flow. After that, plugging in a discount rate at 7.32%, which is based on the WACC of the company, I will calculate the present value of all of that future free cash flow. I will then sum it up, add cash and cash equivalents, and subtract total debt to get an equity value, which I divide by the shares outstanding and get an intrinsic value of $88.60, which is higher than the current trading price. Now, for the multiples valuation, I will compare Sysco to 2 of its competitors. I will take these competitors' current stock prices, divide by their earnings per share, and get their PE ratios, which I will average out and multiply by the EPS of Sysco to get an intrinsic value of $129.10, much higher than the current trading price. And this shows us that Sysco, compared to its competitors, is quite undervalued compared to the earnings they are bringing in. And now finally, moving to the dividend discount model, we will plug in the growth rate of the dividends over the past 5 years and project a growth rate of 3.67% into the future, which will give us an intrinsic value of only $57.94, because as we know, the growth of Sysco isn't that high. And moving to the ultimate valuation, we will average out all the 4 valuation models and get an intrinsic value of $82.55, which is 15% higher than the current trading price of the company, and with a margin of safety of 10%, we would get an acceptable buy price at $74.29. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe, as it really helps me out.